Greek Prime Minister Alexis Tsipras has just finished speaking in Athens. Tsipras saying the Greek government will not take an ultimatum and will not accept blackmail. Let's now look at how investors are reacting to the drawn-out bailout negotiations. Jack Rivkin is the CEO and Chief Investment Officer at Altegris, which has over $2.5 billion of assets. The firm focuses on alternative investments, and he joins us now on set. Jack, great to have you here this morning.
Nice to be here.
How do you strategize around the potential outcome for Greece?
It depends on whether it's short-term or long-term.
Short-term.
I think short-term there will be some sort of settlement. It's in Germany's interest to have something happen here. This is all about Germany. It's not about Greece.
But do you take positions with the...
Our managers do.
Yeah.
Our managers do. But they're reasonably hedged positions. I don't think anybody, at least any of our managers, are sort of making an all-out bet that this is going to go well or this is going to go badly.
Do you sort of have one strategy for what happens if they default and one strategy for if they leave the Eurozone?
Well, it's the same strategy for both.
Yeah.
The strategy has to do with the dollar. Odds are the dollar is going to strengthen no matter what here. And so that's the strategy.
All right, so if the dollar is going to strengthen and you're looking to put some money to work, where's the best place to do it? Where's the opportunity now?
Well, the opportunity could be on both the debt and the equity side within the U.S. or just North America in general. I think you could step up to Canada, which has been sort of ignored here, but it's very much tied to what's going on with us. And you could look at Mexico.
Natural resource play in Canada, or you want to stay away from that?
Natural resources, we're pretty much on both sides of that market right now. You're sort of going where the strength is, and that's where all these assets are going to end up before this is over. But I think you can buy what I call the beta play on the U.S. market here. Now, we're not talking about a substantial beta play here. I think.
But what would explain how that would work, or what an example of that would be?
Well, you'd buy the spiders. You would basically just make a beta play on the market. I don't think it pays to try to be too cute here. You know, we're in an economy that is sort of a bit messed up right now. It's growing very slowly, and I think will grow very slowly for the next 5 to 10 years. So I'm not so sure that you're looking for sectors. If I were going to go anywhere, I would go to technology. That's where I always go.
You think the U.S. market grinds 5 to 7% higher by year end?
It's going to about keep up, I think, 5 to 7% for the next several years, just sort of tied to nominal GDP. You got profit margins at a very high level. You've got wages likely to rise, and you've got top-line growth that's going to be low.
So what are the biggest threats to that assumption of 5 to 7% grinding higher growth for the next couple of years? For example, we have a guest coming on later in the show who says, what if all of a sudden wages do actually start to accelerate? That's could knock us back into a recession.
It's not going to knock us back into a recession because if wages accelerate, that's more consumption going into the marketplace.
But if wages accelerate, maybe the Fed
it's not recession. It's lower profits. Lower profits are not a recession. That's the big difference here.
You mentioned technology.
Yes.
These valuations of these privately held companies like Uber, like Planeteer, things like that, still good? I mean, that's alternative for some people.
Well, I think the valuations are very high, and not valuations that you could actually realize in the public markets, but that's what's going on here. The average.
You saw that Fitbit IPO that just right?
Yes, I did.
Yeah.
Yes, I managed to see it. I can even spell Fitbit.
You have one?
No, absolutely not.
Would you buy the stock?
No, I wouldn't buy the stock. I think valuations in the public market are very high. Valuations in the private market are high. And we're extending the period before a lot of these companies are coming public. The average time to get a liquidity event now out of venture capital is 11 years. It used to be 7. And in the dot-com era, it was 4. So we're in a different era.
So what does that tell you?
I have a lot of patience.
It tells me that, one, there's a lot of money available in the private market, and there's no need to have to deal with the public, if you're staying in the private market.
No, certainly. I mean, WeWork is worth $10 billion.
Yeah, I know.
This week.
Well, it's not worth, but that's what it's being valued at.
All right.
Critical correction. Thank you.
Thanks very much. Jack Rivkin, Chief Executive and Chief Investment Officer at Altegris.